My name is Ross Levine. I'm a professor at Haas. Hopefully I taught some of you, and this talk is going to be about Coronomics. It's going to be about the economics of the coronavirus. I'm going to try to provide a historic perspective in figuring out and discussing what's happening to the economy, and I'm going to focus on the US economy. What are the policymakers doing and the likely implications, and give some comparisons to other crises. And then I'll spend a few moments at the end talking about some research that I've done about corporate resilience to COVID-19, how have particular companies fared in 2020. Even though there's so much pain from the disease, my talk is going to be about the economics, where there's also been pain, but not the type of health pain that many people have suffered through. So a big part of the message in terms of what's going on is that the world has shut down, that many people are not working. Unemployment claims or claims for assistance have gone up 22 million in the last month. And unemployment is headed toward 20%. And this is from less than 4% before COVID-19 hit. Just to give you some comparisons, if you look at the 2008 global financial crisis, during the worst month during that crisis, which was called the greatest crisis since the Great Depression, the largest increase in jobless claims in any month during that time period was less than 1 million, and this time it's 22 million. And the unemployment rate reached 9% during the 2008 global financial crisis. It reached that in 2009. So the impact on Main Street has been quite severe in comparison to the crisis from 2008. The impact has been less severe on Wall Street. COVID-19 crisis in 2020, market is down about 12%. It depends day to day. I think I computed this a couple of days ago, so maybe now it's down 14%, 15%. Over the last year, the market's down 3 or 4%. If you look at the 2008 global financial crisis, the markets fell during the initial period of the crisis by 41%. And if you go from the 2007 high, just before there was the meltdown of Fannie Mae and Freddie Mac and Lehman Brothers, to 2009, when the market reached sort of a low during that crisis, that period the market fell 53%. So the market still might fall, of course, during the COVID-19 crisis. But so far, the impact on Main Street has been quite large relative to the 2008 crisis, but the impact on stock markets has been more muted. There's sometimes comparisons to the Great Depression, and just to give some perspective on this, I don't think anybody is contemplating that the COVID-19 crisis is going to be the Great Depression, and that's for several reasons. But just to give you some numbers, unemployment was close to 20% for 8 years in a row. And it reached 25% in 1933, and it was above 20% for 4 sequential years. So the Great Depression was not only severe, it endured for many, many years, and people just don't expect that to happen with COVID-19. Also, when you look to the stock markets fell by 90% in the Great Depression, and they didn't recover to their pre-depression highs for 25 years. And so again, I don't think that that's something that we're facing. The 2008 global financial crisis, just for a benchmark, recovered in 3.5 years. So what is happening? The economy is shut down. Unemployment has soared. Markets are volatile, and we see that almost on a daily, sometimes an intradaily level. There are times I've been interviewed in the press where people have kind of talked about the market going down. They call me up during the day, and by the time we get on Zoom or on the phone, the market is going up. And so the entire nature of the conversation has changed just to sort of reflect the volatility of markets. The spike in unemployment is unprecedented. Never has it gone up so quickly. And there's no reason to believe, however, there's really no reason to believe this is going to be the Great Depression. So what are policymakers doing? And I'm going to focus on two entities among the policymakers, the Federal Reserve, the US Central Bank, and the federal government, the executive branch and the two houses of Congress. There is something I want to point out that has come up in several happy hours that I've done with some former students, and that is fewer people are working, less is being produced, and so we're collectively poorer. And that's just the bottom line. No policy is going to change the fact that with so many people not working, that overall the global economy and the US economy are worse and people are poor, and that is not going to be reversed by policies. What the policies can do is mitigate the effects and allow the economy to bounce back once the public health issues of COVID-19 are dealt with. So that's what I want to talk about. Three types of economic policy challenges. The first is to cushion the impact, and the federal government has played a role there. The other is to reduce bankruptcies, and I'll talk about that primarily in the case of the Federal Reserve, but there's clearly overlap in the policy efforts of the federal government and the Federal Reserve. And then there's another type of an economic policy, which is really the link with the public health policy. And there the issue is, in order for the economy to recover, people have to go back to work. And that involves a public health plan that is going to allow people to feel comfortable about going back to work. So first, in terms of cushioning the impact of the COVID-19 crisis. So I think one thing to recognize is how vulnerable people are to a shock to their income, to losing a job. 50% of adults in the US have less than $1,000 in liquid assets. And what I mean by liquid assets, I mean assets that can quickly be sold and used to buy groceries or pay for medicines. So for example, a house wouldn't be a liquid asset. If somebody is promised a pension at some point in the future, that's not a liquid asset. 75% of adults have less than $5,000. So with unemployment soaring and all of the uncertainties, a lot of people were and are very vulnerable to what's going on. And that's why part of the fiscal plan has been to get checks out to people and unemployment support so that people can make payments for food, make payments for medicine, and maintain rents or mortgages. So the fiscal plan put out by the government, I think it's popularly known as $2 trillion, but as has happened in the last couple of days, it looks like that's going to increase by about $500 billion, so that the total amount, at least up until now, is going to be $2.5 trillion. A lot of that are loans to businesses. That's where a large chunk of this new $500 billion is going to, in order to keep small businesses afloat and to make that contingent upon, or at least those loans would turn into grants if that money is used to fund employees. There are direct payments of checks to households, there's aid to hospitals, and there's aids to individual states, and tax deferrals. And so the government is trying very much to cushion the blow of COVID-19 on the public. The next thing has to do with bankruptcies. And this has really been the focus of the Fed, and to some degree the focus of the government overall. And it's been the focus in order to keep the economy together. So as many of you know, bankruptcy is a very inefficient process. And during that process, the capital that's used to produce is oftentimes unemployed, which means the people that work there are unemployed. And that's going to slow the recovery. That even once the public health issue is dealt with, if that capital is still in legal limbo, it won't be easily put back to work. The other thing is that if workers separate from their jobs through these bankruptcies, they'll face impediments to find new jobs and new jobs that match their skills. And all of that makes the economy less efficient once people are able to go back to work. And finally, there's an intangible capital associated with firms, teamwork, networks, culture, trust, many of the things that are part of a business school training and that go into making a business productive. And simply selling off capital assets and having people go look for new jobs, even if you put some of the people back together in different places, you'll lose that intangible productivity that is so essential for business and economic success. And so a big goal has been to keep businesses and workers together, even if they're not working during part of this crisis. And that's where the US Federal Reserve, the central bank, has played a major role. And it's quite difficult to exaggerate what the Fed has done in the last few months. So the interest rates that it targets, it's pushed it to zero. So banks that want to borrow from the Fed can borrow at zero, and it has targeted the federal funds rate of zero. And the interest that it gives bank on reserves are zero, so that they take the reserves, so the banks take the reserves that they have at the Fed and lend it out to companies to keep them afloat. It has decided to make unlimited purchases of US Treasury securities and mortgage-backed securities. It's made $1.5 trillion worth of purchases so far in 2020. It's also done a variety of things to support the money market mutual funds and commercial paper markets, and to lend money to foreign central banks, because some banks over there have obligations to firms in dollars that need to be rolled over. And that's amounted to about another $1 trillion worth of assets that the Fed has increased its assets. And as you know, it increases its assets by electronically just creating money and buying things, buying securities. Those are extraordinary measures, but it's also conducted some unprecedented measures. So what it has done, it is making loans to small and medium enterprises. This is about $0.6 trillion worth of loans to small and medium enterprises. And in those loans, banks make the loans, and then basically the Fed goes in for 95% of the action on those loans. So if they make a loan to a company for $100, if a bank makes a loan for a company for $100, the Fed provides 95 of those dollars. It's also entered the corporate bond market, which it hasn't done before. Both in the primary and the secondary market, the Fed is purchasing corporate bonds, and it has stated that it's going to probably purchase about $1.5 trillion worth of corporate bonds, something that it hasn't done before. It's also likely to buy bonds from states and cities and counties, so buy municipal bonds worth another $500 billion. And then some of the discussions that you've seen in the press, I'm sure, this Paycheck Protection Program, where this is where the Small Business Administration through banks will lend money to banks. There'll be a small business guaranteed loan. That is all being levered up by the Fed. So it is essentially going to make those loans with a small equity component that's put in by the US Treasury, so that it can make $350 billion worth of loans to those types of small businesses. And that's going to be increased once Congress passes this new bill. The Congress is going to increase it by $500 billion, which means that the Fed is going to be able to increase it quite dramatically as well. Now, to give you some perspective, the Fed is acting very aggressively, and I think appropriately so, given the crisis that we're in. So just to talk about the Great Depression, The Fed did not trigger the Great Depression, but the Fed did a lot to make the Great Depression great. So even as unemployment was rising, the Fed, in order to protect its gold reserves, tightened credit. It boosted interest rates and it dramatically reduced the amount of credit available to firms, which severely exacerbated all of the economic problems that were coming from other sources. So the Fed didn't trigger it, the Fed didn't cause it, but it made it great. And it wasn't until many years later that it reversed policy, mostly because it was forced to by Roosevelt. So it was not so much the New Deal. It was a new monetary policy that paved the way for the U.S. out of the Great Depression. So the Fed is not making that mistake this time. In the 2008 global financial crisis, the Fed actually played a role in triggering the crisis through very poor regulations of financial institutions and banks. But once the crisis did hit, it didn't repeat the Great Depression. It did aggressively loosen credit and dampen the impact of the 2008 global financial crisis. I think for COVID-19, the Fed neither caused the problem and is doing extraordinary, unprecedented actions in order to reduce the impact on the economy. There are big risks from what the Fed is doing, and there are big risks from what the U.S. government is doing. One of those risks is that the Fed has massively increased its balance sheet. So the Fed's balance sheet coming into 2020 was less than $3 trillion, and it's going to be about $10 trillion probably in the next couple of months. And that's all an expansion of loans and credit into the economy that could at some point be inflationary. Unlikely that it's going to be inflationary in the near term, but the issue is going to be, once this crisis is resolved, how is the Fed going to deal with this enormous expansion of credit? Hopefully loans will be paid back and the Fed can shrink its balance sheet without there being inflation, but there's definitely some risks there in the long term. The other is on the government debt. So the debt to GDP ratio in the US, the gross amount of debt in the federal government, was about 106% of GDP coming into 2020. Given the things that it's done, it's jumped to 116, and with this latest package, it's headed toward 120%, which is about the same debt to GDP ratio that the US had after World War II with a much younger population. Now, is this the right thing to do? I believe it is the right thing to do, but it does mean that there are going to be challenges once the public health crisis is over and once people can go back to work. The next thing has to do with the public health policy, which sometimes is viewed differently from overall economic policies. But at the same time, the overall problem is that for the economy is that people can't work. And therefore, in order to get people to work, there's going to have to be public health policy that allows that to happen. It's quite amazing how incompetent the federal government has been with respect to this crisis. So if you add up some of the things I had on the earlier slides, the US is now funneling somewhere around $7 trillion worth of resources toward addressing the COVID-19 economic crisis. And yet it can't provide testing and basic equipment. Just to give you a comparison, which may be unfair, the combined total economy of Germany and Korea combined is 5.4 trillion, and yet they seem to have full testing and equipment and masks, et cetera. It's truly inconceivable that, that the US cannot have masks and testing widely available and people in hospitals and healthcare workers fully protected. So the implications, beyond the death and the illness, which I understand is much more important, but beyond all of that, is that this is going to be the biggest hurdle to the economic recovery. It's not the Fed, it's not unemployment compensation, it's having a public health policy that's going to allow people to work. And this will cost billions and billions, hundreds of billions, if not more. So sometimes I'm asked with the students, predictions and challenges. I'm wondering whether there will be a call for more competent and compassionate leadership. And this is not so much an argument about whether one is more progressive or one is more for tax cuts, or one is more liberal or one is more conservative in the economic policy ideological realm. It's more about governments, whether you're Milton Friedman and Gary Becker and all of the Chicago schools and the Ayn Rand, or you're more on the left. Governments are supposed to provide public goods. There's really no debate about that. And the government clearly hasn't provided public goods in this crisis. And perhaps people will focus more on competently fixing problems. This is something that did happen after the Great Depression and World War II. There was greater social cohesion about what people wanted and a sharing of many burdens. At the same time, there are going to be very difficult economic choices in terms of taxes and expenditures. And there's going to have to be some combination of taxes and expenditures in order to pay down, in order to address the debt burden that is going to hit the economy afterwards. Society will face some difficult challenges. I wanted to conclude, since we're supposedly at Haas, with some research. And I was doing work that put me in a position to answer, or at least address some questions that might naturally arise given this crisis. So this isn't going to be predictions about the market, although I'm always asked about that. Rather, this is going to be about some research that tries to distinguish among firms and how they responded to the crisis. So as you know, the cumulative stock returns during the first quarter of 2020 have been, there's lots of cross-country differences in terms of overall market responses. China suffered, but nowhere near as much as India or Italy or the United Kingdom. So lots of heterogeneity. This is a graph where on the horizontal axis, what's being graphed is the average weekly increase in confirmed COVID-19 cases. And it kind of starts this count after the 100th case. And then on the vertical axis is the average weekly stock return since that 100th case happened in a country. And you can see here also, there are very big differences in how the markets have responded to the increase in cases. But the heterogeneity is even noticeable if you look within an industry, within a country. So for example, if you look at manufacturing firms and you just look at their stock price highs and their stock price lows in 2020, the average decline is 29%, but the standard deviation is 24%, which means that even within the US manufacturing industry, there's enormous variability in terms of how stock prices are performing. And that's the question that I ask, and I asked this with a couple of co-authors in Hong Kong who I've been working with for several years. So the economy truly is global, even if we can't kind of travel and see each other in person. So the question we ask is, what explains the degree of corporate immunity or corporate resilience to COVID-19 cases? We examined 6,000 firms across 56 countries, and there's some surprising and unsurprising results that I thought I would share with you. So first, some of the unsurprising ones. So they may be intuitively appealing, but nobody has shown this before. So what we do is we look at stock returns for firms, and then we relate that to the number of new COVID-19 cases that are discovered in a country, and we see what happens to the stock returns of those individual firms. And what we find is that the stock prices, the stock market values firms much more highly if they came in with more cash and less leverage. When I mean they value them more highly, it means that given that there's this shock that hits two otherwise similar firms, and we can control for many things about the firms. So the shock hits two otherwise similar firms in the same country, in the same industry. And we can see that those firms that started 2020 with more cash and less leverage, their stock prices fell less. So the market was able to distinguish among those types of firms. Okay, the next thing we looked at has to do with corporate social responsibility. And there's a lot of debate about corporate social responsibility. Some people say firms should do corporate social responsibility because it's the right thing to do, and that might be. Some people say firms should not do corporate social responsibility. Firms have a fiduciary responsibility to their shareholders, and they should maximize shareholder value. And corporate social responsibility is deviating from that goal. But there's a third view, and the third view says, yes, managers, executives should maximize shareholder value. But part of maximizing shareholder value is providing corporate social responsibility. That by being upfront, honest, good with workers, providing a safe environment, opportunities for expansion, by adhering to good business practices, not just trying to do anything within the context of the law that one can get away with, but doing all of the implicit and expected things associated with relationships with suppliers and customers, that this builds trust. And since business is based on trust, not just on formal contracts, that having that social capital through the building of corporate social responsibility can make a firm more profitable. It is a device for maximizing shareholder value. And that social trust built up through corporate social responsibility can make firms more resilient. And so what I mean by making firms more resilient is that the shock hits, and now all of a sudden, all of these relationships with non-shareholder stakeholders, whether it's workers, suppliers, customers, communities, if they have to be managed a bit in order for this firm to survive, that's going to be easier if that firm has built up a lot of trust through its actions by protecting the environment, by being a good citizen and a good colleague with workers and suppliers and customers. So in this sense, corporate social responsibility could be very profitable. And that's exactly what we find. We find very big differences. So again, you take two otherwise similar firms, and it's the firms that had this greater social trust going into 2020 that have done much better in terms of stock returns when exposed to exactly the same COVID-19 cases. The markets also penalized executive entrenchment. So we use many devices to measure executive entrenchment. So this could be the standard things, poison pills that make it difficult for outside firms to take over a firm. There can be also things where the executive the CEO is also the head of the board, or where they've structured the board in certain ways so that the executive has a lot of discretion both over the firm and in terms of preventing takeovers that might put the executive out of a job. And if you think about a crisis that is causing all sorts of uncertainties, one of the things that the market might value is flexibility. That is this firm in a position so that it might be taken over from another firm by another firm if that's the best way for this entity to exist as a going concern. And so executive entrenchment, while it might be more or less efficient under normal times, during a time of crisis where you value flexibility, that entrenchment is almost antithetical to that type of flexibility. And consistent with that argument, we find that firms with greater executive entrenchment, there are many, many ways to measure this through corporate boards and through the policies that the firms have. And we have that for these 6,000 firms measured in 2019, that this had a big effect on stock returns. And the other thing that we looked at was the ownership of the firm. So for example, we looked at many different types of owners, but I'm just going to focus on two that give very contrasting results. One is if the firm has a big owner, a block holder, if the firm has a hedge fund that's a big owner. And then the other type of big owner I'm going to focus on is whether the firm has a big strategic investor that is a corporation. Now, if you think about a hedge fund, they oftentimes have trading strategies. And hedge funds also are oftentimes very levered themselves. So if bad news becomes available about a firm, hedge funds may be very, very quick to trade, putting downward pressure on markets, so that if a firm experiences a shock, two firms that are exactly the same, one has a big hedge fund owner, the other one doesn't have a big hedge fund owner, the firm with a big hedge fund owner, its prices may fall much more as its owner tries to liquidate its position. And the exact opposite might be true if a firm has a big strategic corporate investor, because that corporate investor might view that firm as something very profitable in the long run, and therefore it might offer deep pockets in order to keep it together as a going concern. And in that type of a context, markets might really value a firm with a big corporate strategic investor and be more likely to price that good type of ownership once this crisis hits. And that's what we find, that the price reactions were much greater for firms where there was a big hedge fund owner, and the price reactions were much smaller for firms where there was a big corporate owner that could act with deep pockets. So in sum, these are exceptionally challenging times. It's not a Great Depression, but it's severe for many, many people. Policy responses are mixed. I think the Federal Reserve has done an unprecedentedly aggressive and appropriately aggressive job. The federal government's fiscal response has been pretty solid, and the federal government's planning and execution in terms of the public health mission, which is really the key toward getting people to work, has been epically incompetent. And in my own little efforts and own little study, the stock markets have very carefully differentiated among firms during these very turbulent times. I wanted to thank you very much for tuning in, and I wanted to wish you all the very best. And I hope that this made for a bit of a connection with Haas, and hopefully maybe talk to you something about the economy. Bye-bye.